Okay, so welcome to Mrs. Royce's lecture series. This tutorial is going to deal with the accounting equation, which is assets equals liabilities plus equity. So let's get started. Of course, I'm going to ask you the accounting equation every single time. If you look at this one, can you see something that's different? Well, assets are things of value, right? Things that we own. Liabilities, there's the O part, to third parties. This one says stockholders' equity. We'll learn about that later. Right now we're calling it owner's equity because we have a sole proprietorship. So it's assets owned by the owner. As accountants, in the beginning of the accounting cycle, we look at different things. And these business transactions and things that Mr. Delgado has done through the month tell the story. This is telling us that on January 1st, Mr. Delgado started a web services business. So now we know that Mr. Delgado has a service business. He's the owner, and he invested $2,000. So now what we do as accountants is we look over the transactions that happened during the month and we record them. So the first thing we have to do is ask ourselves what two questions. Yes, what account is affected? Do we have one or two accounts usually affected? At least two, right? Perfect. And then we also ask ourselves, do those accounts increase or do those accounts decrease? So what I'd like you to do is take out this sheet and we're going to go through and do it together. So let's look at the first transaction. It says that you received cash from owner. So the first account that is affected is cash. The second account, owner as an investment of $2,000. So now how are we going to track of that? Well, we're going to write our date down first. So our date is January 2nd. Now I'm only going to write this once on this sheet and then just put the numbers from then on. Transaction number is 1 according to our sheet. And it tells us, receives cash. When you receive cash, it's coming in. So that means it's a what? A plus or a minus in cash. Perfect. Plus $2,000 in cash. Now, you know that if we affect this side of the accounting equation, this side must equal. Since we came in and he put in cash, he now has equity in the company, his capital, of $2,000. Now, we want to make sure that we balance, so we bring down the balances of all the accounts. So the new balance in the cash account is $2,000. And the new balance in the owner's equity account is also $2,000. You look and see, do our assets equal the liability plus owner's equity? Our cash assets equals that. Do we balance? Yes, we do. Now we move on to our next. Something else happened on January 2nd. It's our second transaction. So what did Mr. Delgado do? Exactly. He paid cash for supplies. Paid cash means what? Tells you. Paid cash means cash is going out. So he paid cash for $165 for supplies. Now, since we paid something out, what's coming in? What accounts are affected? Yeah, we got in the supplies of $165. Did we do anything with liability and equity? No. So now we have to do a new balance because he's going to want to know how much cash he has. Let's say the office manager is the one that bought the supplies and he comes to you and says, well, how much cash do I have right now? You're going to be able to say, well, Mr. Delgado, you have $1,835 in cash right now. You have $165 in supplies. He still has not touched his investment. And now you can tell him, yes, everything is in balance. You take the $1,835, which is what he has in cash, plus the $165, which he has in supplies. That's $2,000. Does this $2,000, do assets match liabilities? Yeah, they do. They equal. Perfect. So you know. Now you know if he comes to you and says, how much do I have in cash? You can look at him and go, oh, well, Mr. Delgado, you have $1,835 in cash right now. And he'll be like, okay, great. So now let's look at the next transaction. The next transaction was done on January 3rd. Transaction number 3. Take a look at your sheet. What does it say? Paid cash for insurance. So, what do two accounts are affected? So let's put a dot here. Cash is affected and insurance is affected. Now the transaction tells you what happened. If you paid cash, is it coming in or is it going out? You're right, it's going out. Cash went out, we paid for something. Now we're getting something in return, which is an asset, which is the prepaid insurance. We now owe the insurance for $900. Now, we have to balance again. Why? Is Mr. Delgado want to know how much money he has? Of course he does. So since we spent $900, now he only has $935. He still owns the supplies, so he owes $165 in supplies. Now he owns $900 worth of insurance. And then if you go to the next side of the equation, he still has the $2,000 in equity. Now you as an accountant go, God, is everything still balanced? Let's add it up. The $935 in cash plus the $165 in supplies plus the $900 in prepaid insurance. Well, that equals $2,000. Same as equity. Do we equal? Yes, we do. We balance. Perfect. Now we can move to the next transaction. This is going to be transaction number 4. And it happened on January 5th. And let's read it. It says, bought supplies, okay, supplies, account affected, supplies, so put your dot there so you know you're dealing with supplies, on account. Remember, on account means credit, either way. So the on account is the accounts payable. So put your dot there, because then that way you know that you're dealing with accounts payable. So transaction number 4 is, we got in $220 worth of supplies. We bought it on account, which means they gave us credit. Now once again, Mr. Delgado's going to want to know how much cash does he have, so you bring down your balances. He has $935 in cash. Now you look at this and you go, okay, sir, you now have $385 in supplies. You still own $900 worth of insurance. Now we have $220 who we owe to Canyon Office Supply, and we still have $2,000 in equity that we haven't touched. Now let's add up our assets. $935, $385, and $900 equals $2,200. $2,220, I'm sorry. And this side also is $2,220. So now you know you balance. Now let's look at transaction number 5. Transaction number 5 happened on the 9th. And we're looking at that, and it says paid cash on account. Again, read the transaction. Account affected, paid cash. We paid the on account. Okay, now how much money did we pay? If we paid cash, cash is going out. Minus 100. Okay, we paid on what we owed. Do we owe that much money anymore? No, so we're going to subtract it. Again, if you subtract an asset, you have to subtract on the other side of the equation too. So now he's going to say, okay, now there's $835 in cash. We owe $385. We own $385 in supplies. We have $900 worth of insurance. We owed $220 in accounts payable, but we paid $100 on it, so now we only owe $120, and we still have this amount of equity. So now if we total our two sides of the equation, $835, $385, and $900, now this side we have $2,121 in assets, and we balance here also. So far, you're doing a great job. We are balanced. Let's keep going. I'm going to transfer the balances. $835 in cash, $385 in supplies, $900 in prepaid insurance. We still owe $120. We still have $2,000 in equity. This will make it easier when we go to continue to put things on our sheet. So we ended with which transaction? We paid cash on account. So now we're going to do January again. We started a new sheet, so write January. We're going to be on transaction number 6 on the 10th, and let's see what account is affected. It says received cash. So we received cash from owner sales. Sales is revenue. Exactly. So we received cash, which means we got it in, $1,100. We also received that for revenue because we want to keep track of sales. So each of these different categories at the top, cash, accounts receivable, these are all account titles, and in these account titles everything is kept. That way when the owner comes to you and says, well, how much did I make in sales, you can tell him how much he made in sales, and that's one of the points. So now we have to do balances again. You take your 11, he's going to want to know how much cash do I have. $1,100 plus the $835, so right now he has $1,935. He doesn't have any accounts receivables yet. He still has $385 in supplies. He still owes $900 for insurance. Did I say owes? Owns. He owes $120 still on his office supplies. He still has his investment of $2,000, and now he's actually sold some web services. Now, do our assets equal our liability plus our owner equity? Remember, with this expanded accounting equation, these two accounts are the ones that affect owner's equity now, and that's what we're learning. So we're going to add it up and say, okay, we have $1,935 in cash, $385 for supplies, $900 for insurance. So now, Mr. Delgado, you have $3,220 in assets. Now, does that equal what you owe and what you've invested in the company? Let's find out. 120 plus the 2,000 plus the 1,100 equals 3,220. So you balance. Awesome. Everything's looking good so far. Now we're going to go to our 7th transaction, and that is going to be on the 12th. Now read the transactions. What two accounts are affected? You sold services, so he sold his web services on account. Remember, no matter what, on account means credit. When we had on account before, it meant that we were the ones that were extended credit. Now, if we sold services on account, that means that we as the business extended the credit to the other party. So we have to keep track of that, and that is an asset. And the asset when someone buys something from us on account is called a receivable. which means we're going to receive it in later. So if you look at this, it says sold services on account to Main Street for $500. So $500, we are going to have that later. But we also have to say we sold that. So in the revenue piece, we have to increase that to show that we sold those services. So now, let's say this month, Mr. Delgado is going to be like, well, how much do my people owe me because I gave people credit? You're going to be able to say, okay, we have $500 in receivables, money that's going to come in later. We still have $1,935 in cash. We still have the $385 in supplies. We still own the insurance. We still owe accounts payable. We still owe for those supplies. We still have your initial investment. But boy, so far, Mr. Delgado, you've had $1,600 in sales. And that's pretty good. Because what you do is you take the $1,100 plus the $500, and this shows him that this is the amount of sales he's had so far. Now let's see, do we balance? $1,935 in cash, $500 in receivables that's coming in later, $385 in supplies, $900 in insurance, $37.20. Now, is that going to match our assets? Our liabilities plus our owner equity. Let's look. $120 still owed for office. Supplies, $2,000 invested. $1,600 in sales. $37.20. Yes, we still balance. Perfect. The business is running just the way it should. Now let's look at transaction number 8. Number 8 is on the 12th. Again, read it. What two accounts are affected? Paid cash. Cash. Put your dot. For your communications bill. Bill. Small cost of doing business. What account will it be? Yes, you got it. It's expense. Put your little dot. How much money? Alright, $80. So, we took $80 out of cash. Now an expense, as you see, we're going to have to subtract that. Again, what we do on one side, we do to the other when it comes to this. So now he knows that he's had an expense, a small cost of doing business used up in a short period of time. He knows that he's had to pay his cell phone bill. Now he's going to say, how much cash do I have? Well, right now you have $1,855 because you paid your bill. Main Street still owes us the $500. They haven't paid us yet. We still own the supplies. We still own the insurance. We still owe Canyon. You're bringing down your balances, remember? $2,000. We still made this in sales. And now we've paid an expense. Now, add your assets. $36.40. Does this equal your liabilities, your other asset, your other piece of the accounting equation? Yes, $36.40. I hope everybody's getting this. Now we go to our next, transaction number 9. Transaction number 9 was on the 13th. Again, read it. What two accounts are affected? Paid cash. When you're paying cash, does cash go in or out? Out. Paid cash. Boom. Let's put a dot there. We know we have to do something with that. Equipment rental. You just need it for a couple of days. Alright, you're right. That's an expense. So, how much cash did we pay? We paid $400 for the equipment rental. Have to keep track of that expense. Now, we rebalance. $1,855 in cash. We spent $400. Now Mr. Delgado has $1,455 in cash. Those people still owe us the $500. We still have the supplies. We still have the insurance. We still owe Canyon. Just keep bringing it down. We still have the equity. We still have that great sales. Now we have $480 total in expenses. So what do? What's next? You're right, we balance. We add up our assets, the 1455 plus the 500 plus the 385 plus the 900, and it gives us a total of 3240. Now, are our liabilities going to equal that plus our owner's equity? Let's find out. The 120 plus the 2000 plus the 1600, and then you subtract the 480 in expenses. And your amount should be 3240. So we balance. Okay, we have 2 more to go. Now we're looking at transaction number 10. That happened on the 16th. Read your transaction. Received cash from the on account. Where was the on account? Main Street. Exactly. They paid part of their bill. Okay? So you're going to received cash. If you receive cash in, is it a plus or a minus? Perfect. It's a plus. Now, accounts receivable. Do they owe the total 500 anymore if they've paid 200 on it? No. So you subtract the 200. And of course, what do we always do? We rebalance. Now you have 1655 in cash. Now they only owe us 300. The 500 minus the 200. We still own the supplies. We still own the insurance. We still owe the canyon. We still have the owner's equity. We still have the sales. And we still have our expenses. Let's see if we balance. 1655 plus 300 plus 385 plus 900, 3240. And does this equal 3240? Yes, it does. So we balance. Now let's do our final transaction, also on the 16th, transaction number 11. Now this is what's interesting. Delgado's worked for the first 16 days and he invested money in his company, but he hasn't taken out any money for himself. And what that is called is when you have a company where you can withdraw money out as an owner and pay yourself. And it's called a withdrawal. Okay? So I put it under here so you can see that when you withdraw something as an owner, it comes out of your equity account. So let's take a look at it. On the 16th, what did he do? He withdrew equity in the form of cash. So he withdrew equity. Equity is the first account that is affected. Cash is the second account that's affected. If he withdrew equity, that means it's been taken out. And he withdrew cash. Okay? Which means he took out the cash. He put the cash in his pocket and he was able to go and do what he needed to do. So this had to be taken out of his capital. And that's what the withdrawal account does. It gives the owner back some of their investment, some of their capital. So now he's going to want to know, okay, well I took my $350. And you can say, okay, now Mr. Delgado, you have $1,305 in cash. You still, Main Street hasn't paid us yet. We still own these supplies. We still have the insurance. We still owe money here. But now for the first time, we're taking the $350 out of the capital account. So now our capital account is $1,650. We still had $1,600 in sales. And we still had this as an expense. An owner taking money out of the business is not an expense. It is a withdrawal. So, what's our next step? Oh, you got it. You guys are good. Yep, we balance. See if we balance. 1305 plus 300 plus 385 plus 900. Our total assets are 2890. All right. Now, let's look at our liabilities plus owner's equity. 120 plus 1650 plus 1600 minus 480. $28.90. You guys did it. You balanced. This is how you to do the accounting equation. Congratulations. Please see me with any questions.